Welcome to AM Best Audio. As political violence and civil unrest increasingly shape global risk portfolios, insurers are seeking new ways to measure, model, and manage these complex exposures. From emerging signals of social instability to the role of advanced analytics and underwriting, the landscape is evolving quickly. I'm John Weber for AM Best Audio, and I'm speaking today to Sam Haynes, Vice President of Data and Analytics at Verisk Maplecroft, who has been at the forefront of developing innovative solutions, including the industry's first probabilistic SRCC catastrophe model for the U.S. Sam, so glad you could join us today.
Thanks, John. Good to speak to you again.
So, Sam, how are insurers rethinking political violence and civil unrest as part of their risk portfolios, especially considering some recent global events?
Yeah, so the big five SRCC events of the last sort of 5 or 6 years, Chile, US, South Africa, and then the more recent events in New Caledonia and France, they've really focused people's minds on SRCC because we're seeing losses that are rivaling Nat Cat events in similar geographies at similar times. I think the market's really having to think about how it approaches this particular risk issue. And understand that SRCC is very different as a subset of political violence events to things like terrorism, to things like conflict. And they are looking at the way they do things internally. So I think historically, they've used a lot of internal systems, internal methodologies for assessing SRCC. There's sort of a few existing solutions in the market. But I think what people are having to do now is really treat SRCC in the same way that they would think about NatCat. Adopt the same type of rigor of analysis, use the same kinds of tools. So risk indices, which we provide, cat models. We've just launched the first SRCC cat model for the US, and that's what people are tending towards, to really understand and manage this risk appropriately and in line with the losses that it can result in, basically.
What signals or trends should insurers be watching when it comes to social instability and its potential impact on claims and underwriting?
In theory, there's so many. There's probably hundreds that you could draw a line between having some kind of impact on social instability and then resulting in some kind of riot that impacts property. I think the thing that we would stress is that it's really important to look at a parsimonious set of signals and really understand the drivers of SRCC events specifically. So SRCC is really a subset of civil unrest. Only about 1% of civil unrest events actually result in some kind of property damage. So the things that drive, tens of thousands, hundreds of thousands of people marching on the street are quite different to the things that drive rioters and looters burning down government buildings, looting shops, those kinds of things. So we've really kind of honed in on those types of signals. They include a number of things that are very intuitive, inflation, unemployment rates, things that would be kind of drivers of grievance for people. Also things related to perhaps a human rights situation in the country. So extent of police killings, things like inequality, even the kind of political regime in a country. We've seen most of these major events in democracies. You don't tend to see these types of events in authoritarian regimes because the response is very different. So yeah, drivers can broadly fall into 4 groups. You've got some social issues, economic issues, political issues, and then the thing you need people protesting at a large scale. Whether that tips over into a violent protest depends on the presence of a spark, but it's tempting to look at anything and everything, but really you should be looking at a fairly parsimonious set of issues. I'll give you a really good example of something not to look at necessarily. That's elections. Lots of elections last year. Very, very limited electoral related social unrest, civil unrest. Bit of a red herring, which we said at the time. There's other things that are much more important than elections, for example.
Sam, what motivated Verisk Maplecroft to develop the industry's first probabilistic SRCC catastrophe model for the U.S., and what gaps does it fill in the current insurance landscape?
So the cat model is kind of the big sister of the first thing we developed, which is our global SRCC predictive scores. And the reason why we developed the CAT model was to go down the path, follow the path of Nat Cat. So risk indices are very commonly used in the insurance sector for a whole range of different things, not just PV, but also Nat Cat as well. What we were hearing from our clients was that, and prospects, was that index scores serve a purpose. They're useful. They're useful in both underwriting and exposure management. But if you're seeing major loss events, several of our clients, several people we spoke to got particularly stung by the New Caledonia riots, which came out of the blue. And obviously the scale of the US riots was huge historically in the context of the US, which is home to several of the largest SRCC events ever. The motivation really stems from giving the insurance sector the tools to understand this risk and, as I say at the start, treat it in the same way as they would natural catastrophe events. So if they are very used to looking at average annual losses, looking at EP curves, running kind of counterfactual scenarios. So the No Kings protests in the summer in the US, they didn't escalate into a major nationwide SRCC event, but what if they had done? What would that have looked like in terms of losses? If that happens again and there's some kind of spark, how does that affect my portfolio? Likewise, if I rerun, say, LA 92, probably one of the biggest riots in the US historically, what does that look like now given my exposures? So looking at historic events, but also running as yet unseen but plausible SRCC events against your exposures and then managing those accordingly.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Sam, how do you see the role of data and analytics evolving in helping insurers navigate complex geopolitical risks?
I think it's on an upward trajectory. We've had far more conversations, dozens of conversations over the last few years with the insurance sector in relation to SRCC primarily, but also we've talked to people about war on land. We've talked to people about terrorism. Well, that's a relatively minor aspect now, given the drop in losses. Things like active shooter events as well. That's probably a bit more adjacent. But there's lots of interest in approaching these things more quantitatively, rather than primarily looking at accumulations of exposures and then reacting or working off the back of that. There's much more appetite from our perspective for actually modeling the hazards themselves and understanding the drivers, where they may occur very specifically geographically. What are the kind of flashpoints for those events? And you need data to do that in a structured, robust, independent, transparent manner. I think there's a lot of processes that insurers are currently using that are more kind of qualitative. I don't want to kind of sort of down them with faint praise. They've worked. It's a tool that businesses use to make a decision. But if that hazard is evolving over time and becoming harder to measure, and you're seeing losses, you probably need to up the sophistication, up the investment in those tools that you need to help manage that risk going forward. And data and analytics are a large part of that.
Looking ahead, Sam, what do you think will define the next wave of innovation in political risk modeling for the insurance sector?
Historically or recently, it's been events. The reason why I'm talking to you today is obviously a fairly now long-running interest in SRCC following initially the Chile riots in 2019, and then the occurrence of other major events, generally speaking, one a year, but there have been other events as well, and other large protests. There's a lot going on in the world. There's a lot of reasons why people protest. Generally speaking, those don't escalate into SRCC loss events, but generally speaking, it only needs one. It needs a spark for those to really kind of kick off and result in some kind of losses. So it's hard to know what will define the next wave of innovation, but I think the increasing kind of volatility of certain situations in the world and their ability to kick off protests will, I think, see further interest, and necessarily so, in the SRCC space, because you could see, I'll give you an example. So the US now looks a lot like the US did pre-2020. There are countries like Brazil that look a lot like Chile did pre-2019. There's a lot of kind of very dry tinder out there, and all it needs is one spark to ignite that, and you could see the sixth big SRCC loss event in sort of 7 years. It's just very important to look ahead and manage those risks proactively rather than react to events.
Dry tinder, interesting analogy. Sam, as always, a pleasure speaking with you.
Pleasure. Thanks a lot.
I was Sam Haynes, Vice President of Data and Analytics at Verisk Maplecroft, and I'm John Weber for AM Best Audio.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.